On March 1st, 2026, Iran declared the Strait of Hormuz closed. Brent crude surged more than 9% in a single session. WTI crossed $75 a barrel. Barclays told clients that if the situation held, Brent could hit $100. UBS went further. A prolonged closure, they said, could send spot prices above $120. This is not a routine price move. About 20% of global oil consumption moves through the Strait of Hormuz every single day. When that route gets disrupted, energy markets do not wait for headlines to settle. The question is not whether this matters. It clearly does. The question is what you can actually do with it, legally, intelligently, and without taking on more risk than you understand. This video walks through 5 specific moves. Some are low risk. Some carry more volatility. All of them are grounded in real data, not prediction, not hype. Data. Before any move, you need to understand the setup clearly, because crude oil is one of the most complex assets in the world to time. The EIA's February 2026 short-term energy outlook projected Brent would average around $58 a barrel for the full year. JP Morgan Research published a similar baseline of around $60. Both forecasts were built before the Iran conflict escalated. As of March 3rd, Brent was trading near $74 to $82 depending on the session, well above those baselines, driven purely by the geopolitical risk premium. WTI, the US benchmark, was testing the $75 to $80 range after spending much of late 2025 near $55 to $58. Morningstar's US Energy Index rose 22.59% over the previous 12 months as of February 10th, outpacing the broader US market index by more than 7 percentage points. And after drastically underperforming the S&P 500 in 2025, energy stocks are back in focus in 2026. The setup is real, but so is the risk. This is a spike driven by a specific geopolitical event. Traders who bought crude after Israel struck Iran last June 2025 and held through the ceasefire saw prices reverse sharply when the conflict cooled. The same pattern is possible now. What follows are 5 moves organized by risk level, lowest first. The 5 moves, lowest to highest risk. Number 1, energy. ETFs, broad sector exposure. If you want energy exposure without picking individual winners, the 3 most referenced ETFs right now are XLE, VDE, and XOP. XLE, the Energy Select Sector, SPDRETF, is the largest, with more than $31 billion in assets. It holds energy companies in the S&P 500, led by ExxonMobil at 23.6%, and Chevron close behind. Expense ratio is 0.08%, extremely low. It also pays a 3.3% trailing dividend yield. VDE, the Vanguard Energy ETF, holds about 110 energy stocks and a similar top-heavy structure around ExxonMobil and Chevron, with a slightly lower 3.1% yield and an expense ratio of 0.09%. XOP, the SPDRS&P 500 Oil and Gas Exploration and Production ETF, is the most volatile of the 3 because it concentrates on upstream producers who are most directly exposed to crude price swings. It is less top-heavy, with no single stock above 4%. For Canadians, XEG, the iShares S&P/TSX Capped Energy ETF, is the benchmark Canadian equivalent, heavily weighted toward Canadian natural resources and Suncor. U.S. energy ETFs took in $493 million in net inflows on January 6th alone, and another $226 million the following day when the Venezuela situation escalated, according to ETF Central. That institutional rotation is already in motion. Number 2. Integrated oil majors, XOM and CVX for income. If you want to own individual companies rather than a basket, the integrated majors are the most defensible position in a volatile oil environment. ExxonMobil generates over $10 billion in annual free cash flow at $60 Brent. It remains cash flow positive at $45 Brent. It has raised its dividend for 41 consecutive years, dividend aristocrat status, and yields 3.7% right now. Chevron yields 4.2% and trades at a discount to its intrinsic value estimate, according to most analyst models. Both stocks moved higher pre-market on March 1st when the Iran news broke, while S&P 500 futures dropped more than 1%. Devon Energy, which completed a $21.5 billion all-stock acquisition of Coterra Energy in February 2026, trades around 24% below Morningstar's fair value estimate as of mid-February, making it the most undervalued major E&P on Morningstar's current coverage list. The integrated majors pay you to wait. That is why they are the anchor position in a volatile oil thesis, not the speculative one. Number 3, midstream pipelines, the toll road play. This is the move most retail investors overlook. Midstream companies, the pipelines and LNG terminals that move oil and gas, earn toll-like fees regardless of the exact price of crude. They get paid on volume, not on price swings. The Alerian MLP ETF, ticker AMLP, holds 13 midstream master limited partnerships and yielded 8.1% in early 2026. That is more than double the S&P 500's current dividend yield and well above Treasury rates. The largest holding is Plains All-American Pipeline at 12.6% of the fund. Expense ratio is 0.85%, higher than a plain equity ETF, but the income justifies it for many investors. Cheniere Energy, separately, sits between U.S. natural gas producers and global LNG consumers. It has long-term purchase agreements covering 90% of its volume, many stretching 2 decades. Morningstar rates it a wide economic moat. Expansion projects at Corpus Christi are expected fully in service in 2026. Midstream is the lowest volatility way to own energy infrastructure when crude prices are elevated. Number 4, USO, direct oil price exposure. The United States Oil Fund, ticker USO, tracks front-month WTI futures and is the most widely traded direct oil price ETF with over $1 billion in assets under management. When crude spikes on a geopolitical headline, USO moves with it, quickly and cleanly. But here is the warning you need to hear clearly before touching it. USO is built for short-term tactical positions. It is not a buy-and-hold product. The reason is something called contango drag. When oil futures roll forward at higher prices than the current contract, which happens frequently in normal market conditions, USO loses value even when spot oil prices are flat. Over months and years, this erosion is meaningful and it compounds against you. Use USO to express a short-term view on a specific oil price spike, the kind created by a geopolitical event like the current Strait of Hormuz closure. Do not use it as a core portfolio holding, and absolutely avoid the leveraged version, UCO, which offers 2 times daily WTI exposure and is suitable only for experienced traders with very short time horizons. Number 5, natural gas, the secondary beneficiary. The Strait of Hormuz is not just an oil choke point, it is a critical LNG route. European natural gas markets surged more than 20% in the days following the closure, according to NPR's March 2026 coverage. U.S. domestic natural gas spot prices remained more contained because the U.S. is now a net LNG exporter. But Henry Hub averaged $7.72 per MMBTU in January 2026, up 81% from December, driven by winter storm fee and large inventory withdrawals. The EIA raised its Henry Hub forecast by an average of 40% from its January estimate, and now expects natural gas to average around $4.30 for the full year. Natural gas is also the bridge fuel for AI data center electricity demand. The EIA projects. Data center electricity consumption is growing rapidly across Texas and the Mid-Atlantic, primarily being met by natural gas and solar. This gives natural gas a structural demand story beyond geopolitics. You can access this through AMLP's LNG pipeline holdings, or through individual exposure to Cheniere Energy. Three things that need to be said plainly. First, geopolitical oil spikes often reverse fast. When Israel struck Iran in June 2025, Brent posted its largest single-day gain since March 2022. Then a ceasefire was announced and prices fell sharply. If the Strait of Hormuz reopens or a ceasefire is reached, crude could drop $10 to $15 a barrel in a session. Anyone who chased the spike would take that loss. Second, JP Morgan's baseline for Brent in 2026 is still around $60, built on a global supply surplus that has not gone away. The EIA projects global oil production exceeds demand through 2027, building inventories. The geopolitical premium is real, but it is sitting on top of fundamentally bearish supply data. Third, never size a commodity position so large that a sharp reversal breaks your broader portfolio. Most institutional frameworks treat energy as a 10 to 15% satellite allocation, not a core bet. Dollar cost averaging into dips rather than chasing spikes has consistently outperformed single entry timing in cyclical sectors. Here are the 5 moves, from lowest to highest risk. Broad ETF exposure: XLE, VDE, XOP in the US, XEG in Canada. Integrated majors for income: ExxonMobil at 3.7% yield, Chevron at 4.2%. Devon Energy trading below fair value. Midstream infrastructure: AMLP at 8.1% yield, Cheniere Energy for LNG, direct crude exposure USO for short-term positions only, not buy and hold, and natural gas as the secondary beneficiary of Strait of Hormuz disruption. The window on a geopolitical oil spike is short, history says so, but the income from quality energy companies, the dividends from majors who generate $10 billion in free cash flow at $60 oil, that is a longer-term story that does not depend on the headline lasting. This is not financial advice. Talk to a qualified advisor before making any of these moves. But if this breakdown was useful, you know what to do. And drop in the comments which move you are looking at most closely right now.